Good morning and welcome to Sara's Opening Bell. Today, we're talking quarterly earnings, tariffs, and what it means for you as a stock market game investor. And after two straight record high closes, Wall Street took a slight hit yesterday morning after Walmart released its quarterly earnings report. Now, Walmart operates the second largest e-commerce platform, but continues to lag behind Amazon in online sales. But financial analysts believe that Walmart's physical store presence could matter more than its online sales in 2025. But even with their positive outlook, shares of Walmart decreased by 7% ahead of Thursday's market open and put pressure on other consumer stocks as well, like Target, whose shares dropped 2.5% after the announcement. Target is scheduled to report their earnings on March 4th. But they weren't the only companies releasing reports this week. Wayfair, the online destination for all things home, also reported financial results on Thursday for its fourth quarter, and they climbed 6% despite a wider than expected fourth quarter loss. Now, Wayfair expressed a total net revenue of $3.1 billion, which is an increase of $7 million year over year. However, their US specific net revenue came in at $2.7 billion, an increase of $30 million, up 1.1% year over year. Carvana, the online used car retailer, released their earnings report on Wednesday and initially saw a decline of nearly 10% before the opening bell, despite their earnings and revenue exceeding analyst estimates. Alibaba, the Chinese multinational company specializing in e-commerce, retail, internet, and technology, saw their shares soar to nearly 11% ahead of the open. Now, in its press release, the Chinese e-commerce giant highlighted 13% quarterly cloud growth and AI-related product revenue, rising them to triple digits. Now, Shake Shack jumped 10% after their quarterly earnings results. Shake Shack opened 43 new company-operated Shacks and 33 new licensed Shacks during the fiscal year 2024, seeing an increase of 15.2% from 2023. Now, other than quarterly earnings, what's been making the headlines this week are tariffs. Now, tariffs can seem controversial, and for most, they simply raise the price of imported goods. But what is their actual impact on the stock market? Let's discuss. Now, first off, what is a tariff? A tariff is a tax on imported goods. And the goal of tariffs is to stabilize prices or reduce imports in order to support domestic businesses that compete with foreign companies. And contrary to popular belief, the cost of tariffs is often shouldered by companies and the consumers that buy the imported goods. The Trump administration recently announced 25% tariffs on Canada and Mexico. But what does this mean? CFA Charles Lewis shared a really great example. So let's say a Canadian lumber mill sells plywood to home improvement retailer Home Depot. Neither the Canadian mill owner nor the Canadian government pays the tariff. Home Depot or one of its domestic suppliers does. Now, this would incentivize Home Depot to buy from a domestic producer, and any domestic mill now has a 25% price advantage over foreign competitors. Now, that's the rationale for the tariff. As a result, American lumber mills could enjoy the increased profits and a better performing share price. But what about Home Depot? Home Depot must now make the difficult decision of raising prices to maintain its profit margins or absorbing the cost of the tariffs itself. If they choose to absorb the cost, the tariffs could be damaging to Home Depot's profitability and potentially its share price. So, tariffs are going to affect companies differently. Retail operations such as Home Depot, Walmart, Amazon, and even mom and pop shops may be affected negatively. Logistics and shipping companies are also impacted because the demand for imports falls when tariffs are high. However, domestic producers such as steel mills and automakers can benefit from the reduced competition. Now, the pace and magnitude of the impact of these tariffs are unclear. Investors are concerned as to how long any of the tariffs will be in place, whether they are solely a negotiating tactic, and whether they will ultimately have an impact on inflation. Because if inflation remains elevated, due in part to the higher cost of imports, the Federal Reserve will be forced to keep interest rates higher for longer. So, although the headlines around tariffs have amplified economic and political uncertainty, and they tend to create volatility in the market, the dips are often short lived, and the long term trend of the market is actually up. Now, while tariffs can influence market conditions, it's generally not a good idea to make drastic changes to your investment strategy based on short-term policy shifts. Focus on maintaining a diversified portfolio of high-quality investments that can withstand fluctuations in specific market sectors. Take a look at previous segments where we discuss investing across market conditions so you can continue to make choices that work best for your stock market game portfolio. See you next time because markets are now open.